Viewers, welcome back to Dukascopy TV today. Well, we are going to have a look at CAPEX, which are capital expenditures that create future benefits. Well, the uncertainty in the global economy and markets has led to a lack of commitment by the corporate sector to invest in capital expenditures. I have Mourtaza Asad with me from Société Générale in Geneva to have a look at this. So welcome today.
Hi.
So, you know, capital expenditures have a long way to go. Now, why do you think it is the right time to invest in capital expenditures?
We're really focusing on the US, the North American sector, and we found out that there was a lot of uncertainty, especially fiscal and political uncertainty, especially at the end of last year, and it really froze management and CEO of corporation into their investment plans. So they all altered everything, and now we figured that things are improving on the sentiment, on the I would say uncertainty side, and really there is a big backlog of capital expenditure needs that are ready to be fulfilled. The first is the idea that corporates are now for the next 2-3 years going to focus really on growth. Top line growth, top line revenue increase, and this means investment, taking commitment for investment, then therefore capital expenditure. The phase we have closed now is the phase of restructuring, of cost reduction. We can see on the chart that cost reduction being simply said into job cuts is really finding a flow right now. Job cuts are really down, and the result is that the margin, as here we see the EBITDA margin, has been restored to level almost above the crisis. This is excluding financials, of course, and they are standing about 19%. So it's a very healthy margin. Now really management is going to focus on the next leg of growth, to increase profit, which is the top line and not only the cost reduction. So we're back into the idea that there is a need for CAPEX. Second factor is why now? Really, why do we think what didn't happen 6 months ago is going to happen now? If we look at the second chart, we see it turned a shift in sentiment following this end of uncertainty. We see surveys from the ISM, even from Michigan or Philadelphia Fed indication that surveys on expectation or plans to invest, plans to increase CAPEX is very strong in the next 6 months, and it's turning up. We see on the chart, and we expect this really to increase along for the first and second quarter and materialize later in the year into real orders, durable goods, etc. Another example of the need of CAPEX is the aging of equipment. Because of this lack of CAPEX for the last 3 years, and also for the low level since the crisis, the average age of equipment in America, especially industrial sector, is increased. It has increased about 1 year over the last 10 years. Compared to 2002, the average age of an equipment was 6.5 years. Now it's about 7.5, which is close to record high of the last 30 years. And the equipment is not of the same type than 30 years ago. So usually equipment would have a lifetime even shorter. So it means that this 7.5 year means even longer utilization or excess utilization obsolescence in the existing capital that needs for replacement. What also goes with sentiment is that we need CAPEX when there is an increase in capital utilization. When utilization rate of the industry is high or is getting higher, you need to replace, you need to increase equipment. And we see that those two lines have lagged one another. The increase in utilization rate of equipment has increased by 5 percentage points, and it has not been followed by a CAPEX increase yet. And we're back into the CAPEX is lagging and is now going to catch up from the growth cycle. And management is able to do it because it has cash. And all the elements are there for the CAPEX cycle really to build in and take speed over the year.
And Mourtaza, key major markets such as auto sales and real estate are actually steadily improving. Now, why is this?
This is really key for our scenario of US CAPEX recovery. You don't do CAPEX if the final sale, if the consumer markets are not turning up. And the biggest consumer market in the US is, of course, the housing, the construction sector, and the auto sector. And those two are turning up for a simple reason. they've been so low for so long that they are just returning to normal level. We can see that we are halfway to getting the normal level of home building in the US. Demographic needs means about 1.5 million new homes every year, and we were flat at about 700,000 homes a year for the last three years, and now we're back into going up to this 1.5 million per year. So you see the growth, the potential for upside is very huge in the construction, and it's happening now because people are returning into the new homes, or just building new homes, or just buying the existing ones that are on the inventory unsold. And the second market, the auto market, which is more a cyclical market, is also taking over because the average age of a car in the US is also at record high. So there is need for replacement, a natural need for replacement. It's not having a third car or a fourth car or changing to an SUV. It is just changing the existing car you had that is now 5 years older than it was before the crisis. So it's just a return to normal that we see on the two final market, the consumer market, for big items, homes, cars, which means also furniture, which means also a lot of services for the car. That will drive the expectation for management that they're confident that they can invest in capacity building because the end market is going to increase. And it's already happened. Home market, housing market has been rebounding for the last 12 months. And we see that in the stocks of home builders. But here we're not talking about home builders, we're really talking about CAPEX and the companies and the corporates that build the equipment, the electrical equipment, the machinery, those, I would say, long cycles, not short cycles. We are in the long cycles type of sector in terms of industrials.
And Mourtaza, what areas should we expect to see capital expenditures?
So it really depends on the industry. It depends on the growth of the industry, the demand, and also the obsolescence of the equipment. If we see on this chart, the average age is high in all sector of manufacturing. It's almost always higher than usual average. You see, it's 1.4 years older than it used to be in fabricated metal products. And you can find out that where the obsolescence is the highest compared to average, you could expect the highest replacement needs, maybe for furnitures, also for electrical transmission and distribution. But it is also driven by the final demand and technology changes. We know that there are few sectors like energy, where there is a big revolution in terms of energy efficiency or green technology or electrical transmission that is much more reliable and much more efficient. And those are going to be the sectors where the CAPEX will come up faster than other sectors. We also think about technology in terms of information technology, but here it's nothing new. It's just the cloud computing is so big that we know there will be a lot of capital expenditure to take this revolution in March. That's more, I would say, bottom-up approach to say what are really happening at each industry level. What is the technological revolution there is in a sector that for the company to remain competitive, they really need to catch up. So here I would say it's a mix of factor. We think about cloud computing, we think about energy efficiency, we think about robotics, automation, a part of the reindustrialization idea we have in the US in some high-tech manufacturing sector, where robotics is going to be much more dominant than just labor-based manufacturing, and also all the security, the safety products we think are also on the track of being, highly invested.
Thank you very much.
You're welcome.
Well, viewers, that is it for right now, but do tune back in on Monday. Have a splendid weekend and see you then.